If you can predict how costs move when activity changes, you can see which decisions will actually make money, and that is exactly what cost behavior is about. In management accounting, cost behavior means how a cost responds when the level of activity goes up or down. So we are always asking what happens to this cost if we do more or do less. The core idea is simple. As activity levels increase, total costs will usually increase as well, and our job is to understand which costs change and by how much. Think of a bakery. If it bakes more loaves, it spends more on flour and electricity, so higher activity pushes total spending up. But not every cost moves in the same way. Managers rely on understanding how both costs and revenues vary at different activity levels when they decide how much to produce, what price to charge, whether to make or buy, or whether to accept a contract. For example, before accepting a big order at a discounted price, a manager must know which extra costs will be triggered by the higher volume and which costs will stay the same. Activity levels themselves are driven by measurable things like units produced, invoices processed, kilowatt hours of electricity used, the value of items sold, or simply the number of items sold. In most cost behavior questions in this module, the relevant activity measure is the volume of production, such as units made or kilometers driven, because that is what drives many costs. Knowing how costs behave directly supports cost control, because some spending is tied to what the organization does and how much of it does, while other spending is not. If you can separate the costs that rise with activity from those that stay flat, you can set better budgets and tighter spending limits that match the planned level of work. Understanding cost behavior is essential for budgeting and sits underneath wider decision-making and management control, because almost every plan and performance report depends on how costs are expected to move. When accountants analyze cost behavior, they focus on the specific driver of each cost and work out how much that cost will change when the activity driver changes. In this topic, we classify costs by behavior into 3 groups: variable costs, fixed costs, and step fixed costs, and each group responds to activity in its own pattern. Variable costs change in total when activity changes, fixed costs stay the same in total within the relevant range, and step fixed costs stay fixed only within certain bands of activity, then jump to a new level. To see all of this in action, we use the Bart Hurst car fleet example, where each sales representative's car has several running costs that behave differently as annual kilometers change. The accountant starts by identifying variable costs, those that rise with every kilometer driven, and here, petrol and oil costs $0.15 per kilometer. Repairs are estimated at $200 per year for an average 25,000 kilometers, which works out as $0.008 per kilometer. So repairs are treated as another variable running cost. Putting petrol, oil, and repairs together gives a total variable running cost of $0.158 per kilometer for each sales car. Next, the accountant identifies fixed annual costs, starting with depreciation, calculated on a straight line from a $12,000 purchase price down to a $6,000 trade in over 2 years, which is $3,000 per year. Routine maintenance adds $325 per year, and tax, insurance, and motoring organization membership add $400 per year. So total fixed annual costs for the car are $3,725. Tire costs behave as step fixed. Each $300 replacement happens every 15,000 kilometers. So within each 15,000 kilometer band, the tire cost is fixed. Then it jumps when the next replacement is needed. Now, the accountant calculates total annual cost at a lower activity level of 15,000 kilometers per year. Variable costs are 0.158 times 15,000, which equals to $370. Fixed costs are $725 and one set of tires. Costs $300, giving a total of $395 per year. At a higher activity level of 30,000 kilometers per year, variable costs are 0.158 times 30,000, which equals $740. Fixed costs stay at $725, and 2 tire replacements total $600. So total annual cost rises to $9,065. Comparing 15,000,000 kilometers, you can see how total cost increases as activity rises and how variable, fixed, and step-fixed cost categories each contribute differently to that change. Your takeaway is this. For any cost item, ask what drives it and whether it behaves as variable, fixed, or step-fixed, because that understanding sits at the heart of budgeting and decision-making in management accounting. If this made cost behavior clearer, subscribe for the next video where we build on these ideas with more CPA exam-focused examples.